Friday, June 22. Markets have been quiet all week in a narrow range. Anybody who tried to think about anything lost their train of thought almost immediately to one political explosion after another. The only part of the politics underway that matters to markets is this tariff business. And nobody really knows how to play it. It's inconceivable that it keeps going the way that it's going, and yet it's going the way that it's been going. But no effect on markets this week, except I suspect that the tariffs are suppressing interest rates which otherwise would rise. In the long copy next to this video, Chairman Powell delivered a great speech this week. You know, he's not an economist, so he writes and speaks in English. He was educated by Jesuits, and Jesuits feel that we should all think clearly even if there are political explosions going on underneath our chairs. And the speech is short. There's a link to the speech in the copy. And the question before us all is, the Fed's going to keep going. Powell could not have been more clear that they're going to continue to raise rates gradually. But the question before all of us is how high? How high is up? And a brief history of Fed time. Powell did an interesting retrospective, which in a gentle and careful way indicated that he's doing deep homework. And he's also finding that for the situation that we're in, there's no historical precedent. And all forecasting, unless you are Johnny Carson, was Karnak the Magnificent, and a fortune teller, all forecasting depends on extrapolations from the past. And the Fed's flying blind, and Powell knows it. So where the hell are we? The basic central banking job, trying to keep inflation down and trying to keep the economy going and striking a balance between the two. When the economy is doing very well, the Fed's overnight cost of money should be set some distance above the rate of inflation. It leans into economic activity. And when things are lousy, the Fed's job is to have the overnight cost of money below the rate of inflation, which creates an episode of sort of free money. And that part's pretty clear. Roll the tape back. I mean, go all the way back to, say, World War II, 1945, when modern global economies began and the modern central banking began. And there have been two significant changes affecting Fed policy in that period of time. The first one is, until precisely 1978, if the Fed wanted to create a recession, all it had to do was to increase the cost of money above a Fed-imposed ceiling on the maximum rate of interest that banks could pay depositors. As soon as the Fed's rate went above that ceiling, regulation Q, money would flood out of banks and into treasury bills because they paid more, which meant that banks didn't have any money to lend and had to call existing loans that were outstanding. Instantaneous recession, keep it that way for long enough to cleanse inflation out of the system and then go back to normal. Regulation Q had to go. Electronic money and innovation meant that a cap like that on deposit interest couldn't last, and off it came. Since 1978, the Fed has simply had to raise interest rates far enough above inflation to stop whatever inflation was underway. In the awful recession, 79 to 82, Paul Volcker took interest rates to double the rate of inflation. Inflation was 12%. And mortgages went to 18, and the prime rate went to 22. And a couple of years later, inflation had stopped, and so had a lot of other things. In the little 1990 recession, the Fed again took its overnight cost of money to almost double the inflation prevailing at the time. And if you look forward from that in the chart that's next door, ever since, the altitude necessary for the Fed to reach has been smaller and smaller relative to inflation, and the easing the Fed had to do to get us out of the recession has been deeper and deeper. What happened? Big change number two, precisely 1990. In 1990, the Cold War ended. Uh, we have to fish for the words, but the Iron Curtain came down. Eastern Europe and Russia joined the world economy, and so did China. Since 1990, fundamentally, the world flipped from a tendency towards inflation to a tendency towards deflation. And we were all slow to figure it out. I don't know anybody who saw it at the time. But the combination of globalization and IT has meant suppression of wages all around the world, which suppresses inflation. So, bring that forward, the Fed now is at 2%. The inflation rate, arguably by a half a dozen different measures, is at 2, or a little under. How much above the inflation rate does the Fed need to go to get the economy to slow down just a little? It would be a huge help if the economy would slow down of its own accord, if for no reason whatever, if Fed hikes to date slowed the economy down, even if tariffs slowed the economy down, complicated by the stimulus unknown of the tax and spending bills. But Powell was very direct that the economy is doing very well. It's doing so well that it's growing beyond its current capacity to grow without inflation over a long period of time. It has to slow down. The history of the Fed is we discover recessions in the rearview mirror. The Fed and everybody else says, oh, goodness me, 2 months ago a recession started. And we're all flying very blind, but to have the Fed now at the rate of inflation, crossing over to something above the rate of inflation, puts us on slowdown watch and also on watch for error of too tight as more likely than too easy. I don't mean an unhappy thought. My fervent hope is that the economy just slows down, rates can stay about where they are, and there's a pretty good chance that that's what will happen. Have a good weekend.